afternoon. The Bank of England announced a 0.25% rise in interest rates in the UK last week, which may have gone under the radar for many of you, given that the announcement came literally minutes after the lifting of the energy cap and the huge hike in prices of most people's gas and electric. However, interest rates now stand at 0.5%, which is the second increase in just 7 weeks, after the rate went up from 0.1% to 0.25% in December. And whilst I don't want to sound like the Grim Reaper, I doubt this is the last rise we will see this year, unfortunately. Now, here at Maurice Kilbride in Cheadle, we partner with the Mortgage Advice Bureau, one of the largest independent mortgage brokers in the country, who have now explained how the change in the interest rates will affect you and your mortgage, and what homeowners and home buyers should consider doing to help manage their repayments moving forward. Number one, consider locking into a fixed rate mortgage. Now, this might sound pretty obvious, but depending on the type of mortgage you have, you may or may not be affected by the interest rate rise. And what I mean by that is homeowners whose mortgages are directly linked to the bank rate may see an increase in their monthly repayments. Those who are on what are known as standard variable rates will have to wait and see if the lender passes on the rate increase in full or whether it's just a partial increase, hopefully the latter. Those who have a tracker mortgage are the most likely to see the rate passed on in full, and possibly as soon as their next mortgage payment, so keep an eye out for that. So you may need to act quickly. A fixed rate mortgage could potentially provide a temporary safe haven against upcoming interest rate rises, as they're fixed interest rates and guaranteed for a set period of time. If you're remortgaging, make sure you speak to your current lender about your mortgage terms and in case there may be an exit fee or early redemption charge to consider. Number two, move quickly. Again, this might seem obvious, but any change in interest rates could impact the property market and therefore what mortgage deals are on offer, how prices go, and for how long. Although demand is still far exceeding supply, it's difficult to see these fairly modest rises dampening current buyer demand too much, although I suspect that it might not become clear until quarter 2, 3 or 4 of 2022. The sooner consumers act, the more likely they will be to secure a rate close to the lowest ever levels. And it's worth remembering that. For most people, a remortgage is a fairly straightforward process and certainly not something to be scared of. It just needs some time and planning and, of course, expert advice. Likewise, for those nearing the end of their current fixed rate mortgage deal or who are considering some new borrowing, it may pay to contact a broker or lender to start the process sooner rather than later in order to secure a competitive deal and before they start creeping up. Number three, shop around for the best deal. Again, that's obvious. But for first-time buyers and those looking to remortgage, it's important to look around to see who is offering the best deal, although this can be a minefield if you're doing it yourself. Again, that's why we advocate speaking to a mortgage broker who can help you find the most suitable deal for your circumstances and factor in all the true costs. It's important not only to think about the headline rate, but also assess any additional fees that might be involved. This is where the advice of the broker is going to be so important. Number four, work out what you can afford. Now, creating a budget based on your income and outgoings will help you see if there are any areas where you can potentially cut back and save some money. Budgeting can help you either boost your deposit or assess if you can possibly even overpay your mortgage, which would be lovely. It can also help you create a savings buffer should you unexpectedly find that financial costs or bills arise in the future. Mortgage advisor can also help you with your budgeting and affordability. This will be the first thing they actually look at to ensure you can afford mortgage repayments both now and in the future. And to help you work out your monthly repayments on your mortgage or even your overall monthly spending, you can use an online budgeting tool or mortgage calculator to help, but it doesn't replace using a broker. Number 5, overpay your mortgage if possible. And as I said before, that would be lovely. As mortgage interest accrues on the full amount of your mortgage over its entire term, homeowners can consider overpaying to reduce the amount on which interest is charged. Now, doing this may not only help pay off your mortgage debt faster, but it could also save money in the long run. For example, if you have a £100,000 mortgage over 25 years with an interest rate of, say, 4%, and you pay off an extra £100 per month, you could reduce your mortgage term by around 6 years and save over £15,000 in interest. That's got a lot of money. Keep in mind, though, whether you can overpay on your current mortgage without a penalty. A 10% overpayment facility per annum without incurring penalties is fairly typical of many products, but do check the small print of your mortgage, and again, I can't repeat, speak to a broker. If there's an early repayment fee, it's worth speaking to your mortgage advisor to see if the overpayment charge outweighs the other benefits of making the overpayments before making any definitive decisions. If you'd like to speak to an independent mortgage broker with access to whole of market funding, call us on 0161428 3663, email sales@mkiea.co.uk or visit our website www.mkiea. Hope that helps, best of luck, and we'll catch you on the next video.